So these two headlines basically monopolize the entire finance media channels. And on Friday, we had the read. S&P 500 set for worst day since 2022. And the tech-heavy Nasdaq actually crashed 3% on weak US jobs data. And today, on Monday, you have the Japan Nikkei index posting a biggest single day fall since 1987. There were two main reasons that were cited here. Firstly, it's the weak jobs data. Basically, unemployment rate is slowly creeping up, and we are kind of hinting at a plausible recession in the US economy. And on the second point, which is what there was unraveling in daytime in the Asian country, was basically this idea of unwinding of the Japanese yen as a form of a carry trade. So I'll talk more about it later on. And last but not least, just to throw something into the mix, you have of course geopolitical tension in the Middle Eastern area. So personally, I did join quite a few finance related communities, whether is it on Facebook, Telegram, or even Discord channels, where everyone is suddenly a carry trade expert and they're all offering their different expert opinions. And there is a lot of noise, and for myself, I don't necessarily want to add much to it. Number one, I'm not here to show you fanciful charts. Number two, I'm not here to argue how the macro is going to turn out, whether it's going to head one way or another, because there seems to be quite convincing arguments from both sides of the aisle. But instead, I'll share with you my own general views, some general knowledge, my watch list, and more importantly, what I'm intending to do as the stock market continues melting down. But before that, I'm just going to share a quick summary done up by Kopese letter on what exactly transpired over the last 18 to 24 hours. First, the Japan stock market posts its biggest two-day drop in history. Second, the Magnificent Seven stocks erased over $1 trillion in market cap today. Number three, the crypto markets erased over $500 billion in market cap in 24 hours. Number four, market prices in a 60% chance of an emergency Fed rate cut. Number five, South Korea halts all sell orders on the stock market. And number six, the Nasdaq futures actually fell as much as 6.5% in one single day. So what exactly is going on?
Celebrate Singapore's 59th birthday with 5.9% of guaranteed returns on Poems. So choke your welcome gifts deal valued at over 1,500 Singapore dollars this National Day. Whether you are new to investing or a young investor looking to grow your wealth, Poems has got you covered with unbeatable rewards. So this includes exclusive perks such as 0% commission on US trades for 90 days, 0% sales charge on unit trusts, free live prices, and after opening your account and making your first ever deposit, you can unlock fantastic rewards. So on tier number 1, deposit at least 3,000 Singapore dollars within the first 14 days of account opening, make 3 trades within 90 days, and receive 3 fractional shares of McDonald's, Netflix, and Sea Limited worth 60 Singapore dollars. On tier number 2, deposit at least 10,000 Singapore dollars, make 5 trades, and get 5 fractional shares, adding Alphabet and Apple to your rewards. And all these are worth 180 Singapore dollars in total. And for those of you out there who are vying for the highest tier at tier 3, deposit 20,000 Singapore dollars for a limited time and enjoy a 5.9% guaranteed return for 30 days, capped at 100,000 of new deposits, and it's limited to only the first 1,000 clients. Plus, take advantage of Poems' CFD promo and get exclusive shares in companies like Palantir, TSMC, and even Microsoft, worth 540 Singapore dollars, based on your trading volume. So don't miss all these incredible offers. Download the Poems app today and start your investment journey with the best deals in town. Visit poems.com.sg for more details. Happy National Day, Singapore, and invest smart, live well with Poems.
Now, to preface this, I'm not a macro expert. I did study this idea of a carry trade back in university days, but it was really on a surface level. I don't have deep knowledge, but long story short, I saw this X post from Bunti, and I think it basically summarized this entire situation. So basically, what many traders did was to use this idea of a carry trade, which involves borrowing Japanese yen at a very low interest rate environment. Over the last decade or so, Japan economy has been struggling to get their inflation rate up and coming. That's why they have artificially suppressed their interest rate by quite a large extent. Albeit, the entire world experiencing inflationary pressures and increasing rates. So when you look at this idea of interest rate difference, the intuitive thing is while using that so-called cheap capital to invest into something else. And more often than not, a lot of such traders actually convert it to other form of currencies or even the United States dollar and profiting from the idea of a spread. However, let's not forget that all these are borrowed money, so at the end of the day, you eventually need to convert back to Japanese yen to close the trade. So understanding what the Bank of Japan has been doing, which is trying to hike up their interest rate, the Japanese yen strengthened, and as a result, many of these traders actually lose out on both ends, which is the interest rate differential and the adverse FX movement. Because when they hike up interest rate, the cost of borrowing increases, people want to pay back their loan, that's why they all need to buy back Japanese yen and sell their base currency. And that's when you see the whole FX working against you. And also, when a lot of all these traders borrow money from Japanese yen, some of them even leverage their position, which might essentially trigger a margin call in the reverse when some of these trades work against them. So there can be sharp movements in the market prices over the short term, but personally, I don't think this will have a significant long-term impact. So even though we have seen that this trade have been working in favor of the traders for quite some time now, and it was because of this high rates environment, this high inflationary environment, and this very peculiar relationship between inflation and the interest rates and how the Japanese consumers are spending their money in the Japan economy, that's why there is this so-called free money printer. But at the end of the day, everything will have to normalize back to normalcy. And as you can see, as it slowly normalized back up, that's when a lot of people that were in leverage position were basically caught off guard. But I think not to go into the nitty-gritties of interest rate differentials and the difference between the interest rate and currency, that's not the focus of the topic today. So first things first, I think just to give you guys a quick update on my own personal portfolio. Last Friday, I think I just did a quick computation. I'm going to show you the screenshot here. My portfolio on the aggregate was down around 5.5 thousand, and I think on Monday this was recorded before the market is open, but the pre-market has already started trading, and the overall portfolio, we are down roughly 3.6 thousand Singapore dollars. So in the last 2 trading days or so, I'm down roughly $9,000, and that's around 5 to 6% of my overall portfolio. And I think just to share some of my quick thoughts, because I do see a lot of people in these communities basically crying for their parents, asking what they're supposed to do. This is an emergency, they've never seen the stock market pull back, even on an index level. I think 2 points that I have to make here. Firstly, I think for many of you that has actually went through the whole bear market drawdown in the Hong Kong market for the last 3.5 years, you're probably unfazed by this, especially for those of you with large positions. Full disclosure, I'm still down more than 30% of my BABA position. So this slight pullback, if you look at it on a grander scheme of things, and we are not even in correction territory yet, at least based on pre-market trading, I think the SPY or the S&P 500 is not even down 10%. Yes, maybe the triple Qs or the Nasdaq is down, but it's still not in bear market territory. And if you pull a much longer time horizon, 12 months, 18 months, a lot of these Max 7 names, probably excluding Tesla, they're still outperforming every single other trade ideas out there. If you have been in it since 2020 bear market crash or in 2023, at whatever point you bought, some of these stocks, I think you're probably still in the green. I think the second point is really this idea of frugality. Because when I look at my portfolio and I'm down like, let's say $9,000 in 2 trading days, and when I reflect back upon my life, sometimes I do feel that I'm quite stingy on myself and I don't spend, or I pull back my spending intentionally. I think at the end of the day, it boils down to this idea of whether you're spending your money effectively or not. I'm not saying don't spend money, and of course, I have been through times where I'm explicitly telling myself to not spend money, but I think that's unhealthy. At the end of the day, why we are investing, why we are saving up is to protect our future self. And if we are not going to enjoy the fruits of our labor, I think when I look at this kind of drawdowns, I felt that it was quite meaningless to always be scrimping that, I don't know, 50 cents and $1 when I'm down like $5,000, $10,000 in 1 or 2 days. And I'm just going to quickly flesh out my current portfolio breakdown, accurate as of 2nd of August. So I'm just trying to dispel the idea, and of course full disclosure and transparency, that some of you might think that across some of my other past videos, you think that I'm bearish on China. But I think actions do speak louder than words. And you can see that regardless whether is it on a cost or on a fair value basis, China still makes up more than 50% of my portfolio. And this recent drawdown is mostly affecting my US positions that are congregated in 4 of these names, which is Amazon, TSMC, Meta, and Google. Other than that, I think the Hong Kong market has held up pretty well. from this entire unwinding of the Japanese carry trade. I think this is my own theory, of course, is that a lot of people have been scarred by the 3-4 years bear market in Hong Kong. Many of these so-called traders that are leveraging on some of these positions, they've all fled out of the Hong Kong market. So those that are there, still there in the Hong Kong market like myself, we are kind of the true back holders, and really there's not much use case for us to liquidate now, especially when the valuations are probably near rock bottom. We are not expecting much bad news. A lot of things are being priced into it already. So that's why I guess the Hong Kong market is kind of stable relative to the rest of the other markets. I'm not saying it didn't drop. I think it still tanked like 1, 2, 3%, but not to the extent where we are seeing 5-6% drops on single names, or even up to 8-10%. And if you were to look at my individual US tech names right now, I think most of them are bought in 2022. I started the position and I actually did average up in most of these positions. And even for Amazon, for Meta, TSMC is something that I didn't really touch. I'll talk more about it maybe later on. Google, I think I also added a little bit. But I think the thought process on why I didn't want to add as aggressively, you could say that it's anchoring bias, but I think in terms of valuation, from a valuation perspective, I do think that they're still undervalued. But compared to the previous time when I was adding them in 2022, you can see that some of these returns are ranging in the range of 25 to even 100%. And you can kind of backtrack and kind of estimate where I've bought them. And I know some of you are going to start talking about how Buffett thinks that this market is overvalued because he exited 50% of his Apple position. But that's not the focus of today. I'm just going to talk about what I'm intending to do. So this is just my general views or my overall views of the stock market today. I think the bottom line, for those of you who have been following me, especially in this kind of environment where it's kind of challenging, especially when it's a 1-day, 2-day kind of drawdown, I think a lot of investors will start going down the rabbit hole of saying that they want to try to time the market, they want to be macro investors, they try to study some of these data points and try to prove that, oh, the market might be going down more, the market might not go down. And likewise, you can look at technical charts, you can look at macro indicators, whatever it is, you might be right, but there might potentially be this idea of an illusion of a knowledge. So that's just my own very humble opinion or word of caution for those of you trying to go down the rabbit hole. I think you can justify your position of whether you want to buy the dip or you're selling everything and holding it to cash. But for myself, like I said, I want to be consistent. I think I would just tell people to please stay on the course, buy companies at a discount. Of course, you can argue that the market is overvalued now, but I do believe that there are still quite a bit of opportunities out there, and try to hold for the long term. Now, I think it is out of my competence to basically estimate the market impact of the Japanese yen unwinding. How big is the leverage or how big is the FX risk? What's the geopolitical concerns around Middle East? How the 300 million Americans are spending today and their spending attitude, which might or might not result in a recession, and the Fed's intention between balancing inflation risk versus recession risk. So to me, it's quite simple. If a recession doesn't come, so be it. If it does, even better. And truth be told, you don't actually need it to come anyway. As long as enough people buy into the story, like back in 2022, a lot of economists are predicting that there was a 100% recession, it will be reflected into the stock price because the stock market is a forward-looking mechanism and they try to price in everything. As long as Mr. Market gives you an opportunity to buy more, I think it's something that we should all be excited about. So in terms of my own portfolio, my cash position sits at right around 11 to 12% today. So of course, it's definitely a broad stroke of luck. I didn't have any predictive powers. I'm not a fortune teller. For those of you who know or have been following my own newsletter on my Substack, I've actually sold out my China banks in early July, and I've basically outlined my thought process on my newsletter. So for those of you who are interested, you can visit the 2 previous entries. So you can click in the link below. I basically wrote down everything in the newsletter, and for those of you who are not on the newsletter yet, I don't know what you're waiting for. You will probably get more real-time updates on there. It's easier to write rather than to produce a full long-form video here. But anywho, if you do believe in the market being a good guide of what future expectations are, judging by how some of these essential versus discretionary names, a lot of all these companies, how they're performing and how they're trading, the market in general, on the aggregate, is already pricing in some sort of a slowdown or some sort of a recession. I don't know how deep this whole correction or this whole rotation would be, but I think this is just my general thoughts. I'm slowly deploying some of this spare cash. I'm not urgent to basically deploy everything at one shot. So I'm also keeping in mind that there are many individual, I guess, idiosyncratic risks and valuations and company positions, market positions, some of these risk factors and how they are performing. So I think do keep everything in mind. And I do understand that over the last, I guess, 2 years or so, there's this very strong buy the dip or BTFD mentality, thinking that everything would be a V-shaped recovery. So I'm not trying to speculate or even telegraph how the entire stock market will perform in the next 1 or 2 months, but I'm just saying that it's always good to keep a bit of a dry powder. And I think just a commitment out there, I'm probably going to buy again today, tonight, in Asian time, and I've actually bought on Friday. I've bought a little bit more Amazon. Today I'm probably going to buy a bit more Amazon, and yeah, I will talk more in terms of my conviction list and my shopping list later on. But all things considered, I think like I alluded at the start of this video, we are not even in a bear market yet, and many names are still holding on the very strong year-to-date gains. So just one word for those of you who are very excited, I think just relax. Now, the last part, which is my own watch list and my expected moves. So I think I will rank in terms of the Max 7 names, Meta and Amazon as top of the list. Firstly, you will probably know that I would have higher conviction in these two names because number one, I've been following them for quite some time already, and number two, they are already in my portfolio. So I would definitely focus more on adding onto names that I already have in my portfolio, and I might even do another video comparing the Max 7 and why I only have 3 out of the 7 names. Now, second on the list, which is following the framework of adding to my positions, I think Lululemon and LVMH. Right now, because of this whole recessionary scares and there's a lot of uncertainty around them, valuations are becoming more compelling. But some of you might tell me that, hey, 18 times, 20 times PE for something that might go out of style or something that might be being punished in a recessionary environment might be too expensive. And I hear you, but they're becoming more and more attractive as the share price continues getting punished. Hopefully, I do really hope that the recession story do play out and I can pick them up for cheaper. So I'm also looking to add to them. Even though both of them are probably under 3% positions right now. So I'm looking to add. Now, in terms of other positions, I might potentially be looking to consolidate my Palo Alto and Adobe position. But as a company or as an investment, they haven't really upgraded to the level that I'm very comfortable in holding a sizable position. They're okay in their own rights. They're all leaders. They displayed strong balance sheet. They're good companies. I'm not saying they're bad, but I'm just basically questioning myself on whether they still have a position in my portfolio and whether I really know what I'm doing with these individual positions. Now, onto the Chinese position, which is where most of you are probably invested in as well. For myself, I'm always open to add to my Chinese position. I think depending on the environment, depending on what are the different opportunities out there for me to add, and I guess in a way you can call it opportunity cost, even though I dislike this term a lot in the stock market. But long story short, I did recently add to my Tencent position. I've actually even made a video about it. But I think in terms of position sizing, in terms of diversification, and also not forgetting that if I add on the Hong Kong market, the Tencent position is actually quite a bulky figure because I have to buy in terms of 100 shares, which is one lot. And that is roughly around 6,000 Singapore dollars. So I think if I blow or if I just take up 3 or 4 more lots, and I'll be out of cash. And this is a stark difference when compared to the US counterparts when I can add Amazon like $1,000 every time I add, rather than $6,000-$7,000. So that's just a difference to keep in mind. And last but not least, one of my larger positions, which is in TSMC, it inevitably will extend the discussion into the chip industry. Are you interested in Nvidia and whatnot? I think chips in general, the companies might be running a little bit ahead of itself, but because of this correction right now, or this whatever you call it, pullback, they are looking attractive or looking more attractive. But I recognize the power and the monopoly in terms of Nvidia and friends. So I'll just hold on to TSM, but I don't look to be adding for now unless the valuations become extremely compelling. But in terms of my exposure, I also don't intend to trim. I'm just going to invest for the long term and just hold. For Nvidia is a very special beast. It's a unicorn. It's a company that I wish to own, but valuation is something that I'm finding myself the struggle to try to determine in terms of its projected future cash flow, etc. So maybe next time when I have a better grasp, if Mr. Market gives me the opportunity, I would tell myself why not. Now, in terms of not immediately, my watch list for now, at least in China, in the Hong Kong space, in the China A-share space, I'm looking at very strong consumer brands, companies like Mao Tai and even Hai Di Lao, which is already in my portfolio. I'm basically trying to telegraph some of these consumer trends. And as we know, China has been in a recession for God knows how long. Even though it's not official, you can see that spending is down, manufacturing is down. I guess services are slowly picking up, so that's why I'm slightly more interested in some of these consumer brands. And I'm basically trying to position myself to capture that upside recovery. So yeah, China in general, that's where my focus is on. For Singapore, I'm more interested in blue chip REITs. I'm basically just eyeing some of these top few names. You probably can guess it already because it's already in my portfolio. And I do have a position in them. It's kind of I wouldn't say I'm pursuing some sort of a dividend strategy, but I do think that in terms of valuation, in terms of the location of the property, the assets, the quality of the assets, I think all these are unfairly beaten down over the last 2 to 3 years when interest rate was basically raised at an unprecedented rate. Now, largely in the US, I'm looking at some more obscure companies. I'm not going to mention names now. And if this whole recessionary scare actually do play out, I'm also looking at Visa and MasterCard. And if you just look at these two financial powerhouse, it's always a good buy when there's some sort of a recession. So that's that. And if you guys have any comments, feel free to leave in the comment section down below. And I'm definitely interested in whether you are adding to any of your positions in this current market pullback. Like I said, I've already disclosed the market is not open yet, and I'll be adding tonight. So with that, I'll see you guys in the next video. But more importantly, and hopefully, I will see you guys on the moon. Goodbye.